Okay, you can feel it in the air, right? The market's flashing a pretty serious red alert. A streak that held for months has just been shattered, and there's this anxiety that's taking over. So, what's really going on? In this explainer, we're going to cut through all that noise. We'll look at the technical break, what's driving it, and, maybe most importantly, the surprising historical roadmap that tells us what could be next. It all starts with this number right here, 214. For 214 straight days, the market was showing this incredible stability. I mean, that's an impressive run by any measure. And that stability, it came from the S&P 500 holding strong above a really critical long-term trend line, which is a major sign of market health. For months, it was just this picture of calm, a steady upward march. And then yesterday happened. That all changed, the streak was broken, the market dipped below that key level, and that sent a shockwave through trading desks and pretty much set off alarms for investors everywhere. So what is this line in the sand that is everyone so on edge? Let's get into the technicals a bit and really understand the tripwire that was just triggered. Okay, so this is it, the 200-day moving average. It's not magic or anything, it's just a simple but really powerful tool. All it does is average out the closing price over the last 200 days. It smooths out all the daily noise and gives us a clear picture of the market's real long-term trend. Think of it as the market's true momentum. And listen, this is way more than just some line on a chart. It's kind of the ultimate divider between a bull market, where everything's optimistic, and a bear market, where fear really takes over. Crossing this line can actually trigger a whole cascade of automated selling from huge funds. And for human traders, it's a massive psychological blow. In this chart here, it shows that the weakness isn't just about a few big names dragging things down. The problem is widespread. More than half, 53% of the individual companies in the S&P 500 are already in their own downtrends. The foundation is definitely looking a little shaky. So we've established the market has broken a really key level, but the big question is, why now? Well, as we're about to see, this definitely did not happen in a vacuum. Let's dig into the 3 key catalysts that are pulling the market down right now. You can just feel the anxiety in this number. This is the VIX. A lot of people call it the fear gauge, and it's sitting at an elevated level of 24. Which basically tells us that investors are actively buying protection, kind of bracing for more volatility ahead. And this fear is being fueled by what you could call a trifecta of trouble. First up, you've got geopolitical heat, with conflict in Iran keeping oil prices and inflation fears sky high. Next, that dreaded stagflation word is back, with a 35% chance of recession now being priced in. And finally, you have some corporate drama, with a massive crash in Supermicro shaking the absolutely critical chip sector. Now, beyond all the immediate economic and corporate news, there's a larger force at play, the political calendar. So let's zoom out and see how the upcoming midterm elections are adding yet another layer of uncertainty to an already nervous market. We are in a midterm election year, 2026, and that comes with something known as the midterm curse. And history shows us, pretty reliably, that the president's party almost always struggles and loses congressional seats in their first midterm. And if you look at the current polling data, well, it suggests this historical trend is holding true. With the president's approval around 42% and the GOP's Senate chances falling, Wall Street is bracing for political gridlock. And why does that matter? Because gridlock means nothing gets done. And as we all know, if there's one thing markets truly hate, it is uncertainty. Okay, with all this negative news, it's really easy to feel anxious. I get it. But before anyone goes and hits the panic button, history gives us a fascinating roadmap for what could come next. This is the question on every single investor's mind right now. We've broken the streak, fear is up, politics are messy. So, does this mean we're all heading off a cliff? Well, this is where things get really interesting. History actually tells us that a break like this is often a false alarm. In fact, 1 year after a long streak like this gets broken, the market has actually been higher 70% of the time. 70. It's a surprising and pretty crucial piece of historical data. And that whole midterm election pattern, it just reinforces this idea. The first half of a midterm year is typically volatile and choppy, a lot like what we're feeling right now. But once the elections are over and the political landscape is clear again, the market tends to rally, and rally with force. Get this. Since 1950, the 12 months following a midterm election have never been negative. And we're not just talking about small gains here. The average return for the stock market in the year after a midterm election is a staggering 15.4%. It really seems that once that fog of political uncertainty finally lifts, the market is ready to soar. So, what does this all mean for us right now? I think this quote sums it up perfectly. The easy ride is over. The days of just buying an index fund and watching it go up, well, those have given way to a much more challenging environment. We're now in a show me market. It's more volatile and it demands much more careful navigation. It's not necessarily a signal to run for the hills, but it is a very clear sign that the game has changed. The question now is, which companies can actually prove they're worth it?